You're watching Inside Automotive with Jim Fitzpatrick.
Good morning, everyone. Jim Fitzpatrick. Thanks so much for joining me on another edition of Inside Automotive right here at the CBT Automotive Network. Joining us now to help us break down everything happening in the market, from shifting sales trends to the latest developments on the CARB ACC2 front, is Kevin Tynan, Director of Research at Presidio Group. Thank you so much, Kevin, for joining us once again on the show. It's always great catching up with you. Whenever you're on, there's a spike in our viewership because the dealers know that you bring the good stuff. So thanks so much for spending some time with us. So let's start with March and April sales. What do you have to say about that? Is it a sign of a strong demand? Do you think that this will continue, or does it mean a possible slowdown now into summer?
Yeah, well, obviously the tariff threat, which on one hand was the reaction was surprising, right? Because that was the platform, right? So it was almost like analysts and media and markets and consumers didn't realize this was going to happen. So you had this huge pull forward in the end of March and in April. So to put it in perspective, 2024 was 16 million units. On a seasonally adjusted pace, March was 17.8. Wow. And then April was a 17.3. Right. So I think organically, we're not quite there, so there is that risk of, and then some of the relief in the pressure of tariffs. Deals with the UK, speaking with China, and you know, so there isn't that pull forward, and there could be a pretty decent hangover for May and June, and again, it's tax return season, so typically a good summer selling season. So I would expect a little bit of a hangover, but probably not terrible. But we're not doing 17s every month, you know, from here on out. There'll be we'll retreat a little bit off that going forward.
Yeah, which isn't terrible. I mean, it's still you know, size it up to be a great year, right? Another good year.
Yeah, definitely. You know, and you know, my take on all that is that you know, that pull forward in March and April was demand driven, which when that happens, typically means stronger pricing, less discounting, less incentives, because it's the consumer going to the supply and saying, I want that. Right. Typically, when you have this push from the supply side, because there's too much inventory, you can get a strong seasonally adjusted number. The problem is you had to buy it, right? And that was because of aggressive incentives or lease deals or discounting, where you can prop up the number, but it's not organic and it's costly. So this pull forward was probably not as costly as what we would see typically if it were driven by too many units of inventory, which is sort of borderline right now. But that being demand driven is a different dynamic than what we're used to in the past. Right. What impact will this have on inventory levels and pricing in the months to come? Super interesting stuff, and I've done a little bit of analysis on this, and it's kind of weird to explain, but it took about 10 months to go from 2 million units of inventory to 3 million units of inventory. Since hitting 3 million units, which was about July of 24, since then, actually inventory has come down. So instead of continuing to add, it may be the manufacturers getting some discipline or seeing what the value of that scarcity of supply was through 22, even 21, 22, and a little bit into 23, that it was great for margins for the retailers and for the manufacturers. So, you know, we added 1 million units of inventory in 10 months. In the subsequent 10 months, we've actually decreased inventory. So there's optimism there that we're not going to run back to this super oversupplied market of 4 million units, and everybody's, and when I say everybody, I mean manufacturers and retailers, their profit, their margin strength goes away, pricing power is gone. So there seems to be a little bit of production discipline happening right now, which is a good thing for the for the manufacturers and the dealers, not so much means firmer pricing for the consumer.
Right.
But it's a more organic and pure market in that way.
Yeah, for sure. And this is something that the industry has been challenged with: the increase in inventory, the decrease in inventory, the increase in. I mean, what's the, I guess, the perfect day supply? Any dealer that I ask always says, I'd like a nice steady 30, maybe 40-day supply of vehicles. And how do we, you know what I mean?
Yeah, typically we talk about 60 days being what we would consider manageable, the top range of manageable.
Yeah.
And it's like anything else, right? Too few units, you're leaving sales on the table. Your pricing and your margin power might be a little bit more firm, but you may be losing sales. Too many, obviously, now you have to pay to get rid of those units.
Right.
So 60 days is considered manageable. Typically, you'll see the domestic brands be way more than 60, and you'll see specifically the Asia-based brands be well below that, and that's just how they run their business. But, if you think about it, Jim, like, the demand line in the U.S. is reasonably stable, and that means going back a very, very long time, many, many years, decades even, not seasonally adjusted, will sell somewhere between 1 million and 1.5 million units every month, regardless of how much inventory there is. And that includes when there was 4 million units in 2019 or when there was 1 million units in 2022. That demand line stays very, very stable.
Wow.
So if you think about 1 million to 1.5, 2 months supply of that would be anywhere from 2 to 3 million, which is the range that's probably ideal. So as we started to get above 3, in the middle of last year, you're starting to get a little frothy and concerned that there's that it's 4 million is just around the corner. So somewhere in that range, 60 days, 2 million to 3 million units is what we would consider ideal. And we've pulled off the 3 million. So I think we're in a reasonably good place in terms of margin and pricing power for the retailers.
Sure. I've spoken to a number of high volume Toyota dealers, and they all have said to me that they haven't had over 30-day supply of cars in years, not months, but in years. And it's amazing how Toyota has really pretty much zeroed in on that to say, look, as one dealer said to me, he goes, I got plenty of Tacomas, but that's not what we're selling the heck out of right now. But in terms of all of the other models, we're working on, let's say, a 15-day to a 25-day supply of cars, and that's that.
And what's really interesting, and I think as I'm out and about this summer talking to dealers at conventions and other speaking engagements, that's really, I think, the basis of what I'll be talking about is the value of that scarcity, right? Yeah. And again, it's a fine line between not enough and too much.
Right.
But think about, and the pandemic period, COVID was a great example. As inventory got really low, you were matched up like 30-day supply, but profitability for the retailers was a record, best ever.
That's right.
Right, and then even think about brands specifically, right? Even Harley Davidson, which was always constraining supply, build one fewer than where you think demand is, and then you have super strong pricing and margin power.
That's right.
Ferrari, Porsche, brands like that who are not commoditizing their product and just dumping it in the market, typically tend to hold up better. And you may not be recording the volume numbers that catch people's eyes, but when you multiply that through in terms of revenue and profit contribution, the net pool of that is way better than trying. And it's also easier to find the right amount of buyers than it is too many buyers, right? And if you think about the industry as a whole, if you're going to maximize price and profit somewhere around 15.5 million units, it's a lot easier to find 15 and a half people to buy than it is 17 and a half million people.
Yeah.
Right? Because then they get expensive. Those 2 million people, to get them off the sideline is only because the deal is good. And then that margin comes from you, the manufacturer, or you, the dealer.
Yeah.
So there is an organic point, and I think this market is about that 15.5.
Yeah.
Where it would maximize price and profit for the industry. But the value of that scarcity is something that manufacturers struggle with. And it's not because they don't understand it. It's because there's a certain level of capacity, production capacity in this country. And when it's underutilized, so if you've overbuilt and your capacity is underutilized, you need to build.
That's right.
Those people are getting paid. Those bills are getting paid whether you produce a vehicle or not. So the mindset has been put the people to work. We're paying the lighting bill anyway. Produce a vehicle, we'll figure out how to sell it tomorrow. So we still have that, where if we have understood that 15.5 is a nice healthy place, but we have production capacity of 18 million, we have to address that, right? Because that's expensive too.
Right.
And that may be the next turn, is addressing the capacity issue.
That's right. And in most cases, when I talk to Toyota dealers about that very issue, not having a lot of inventory, less than a 30-day, in many cases less than a 20-day supply of vehicles, I say to them, do you need more cars? And they said, well, to your point, not if it's at the expense of lower gross profits. We'd rather maintain where we are in terms of front-end gross profit on these vehicles and have that demand a healthy one, rather than a 2-month supply of Toyotas sitting behind the dealership.
Now, the other thing that Toyota does well specifically is not being over-franchised.
That's true,
when you
too.
look at the store count for the number of vehicles they produce and sell, it makes for a very healthy and happy dealer base, because you're not competing with somebody on the next corner for allocation, for pricing. So they've done a very good job of not oversupplying anything, whether it's vehicle, whether it's retail points. And they're really, in that sense, kind of considered the model to follow in the right amount of just about everything.
No question. Hey, let's talk about the U.S. House's move to block California's emission mandates. What do you make of this decision?
Yeah, very interesting. And being in New Jersey, right, this is a topic that we're discussing a lot around here. I think at the core, Jim, it's just the creation of an unnatural marketplace.
Yeah.
And manufacturers have two choices. One is, and let's take New Jersey, for example. Let's ballpark New Jersey at 500,000 units a year. And let's call it, for round numbers, 10% zero emission vehicles.
Okay.
So what happens is New Jersey by 2027 would have to get to 43% from 10. So the onus is on the manufacturer to say, okay, so 43% of your 500,000 have to be zero emission vehicles. There's no way we get there. Right. And again, you can sell whatever you want if you sell it for $5, right? So we could have $5 EVs and we can get to the number. It's not healthy, economically for the manufacturers or the dealers. But so if you're gonna force the manufacturer to say, essentially half of your 500,000 units by 2027 has to be zero emission, yet you're probably going to do somewhere about 50,000. Well, then they have two choices. One is continue to sell 500,000 units and miss the Advanced Clean Car 2 goal and pay the fine at, call it $20,000 per vehicle. Or you're going to say, where's our organic demand? Even if we push it a little bit, and now that represents 43 of the allocation we're giving your state. Okay. Now and I've done the math, that could reduce New Jersey's new vehicle allocation by half. Yeah. Right. It could wind up being under 300,000 units. So the question is, what happens to those units? Well, we have 200 miles of border with Pennsylvania, who is not, a CARB waiver state. And the irony is that, okay, so now the allocation goes to those states. I cross the border to get the vehicle that I want, and I drive it back to New Jersey and pollute here anyway, right? So because that's the interesting thing to me, is that, and I've actually discussed this with a lot of people in a lot of high places, is that the argument seems to be from politicians that are behind adopting CARB and ACC2 is that we want cleaner air. Right. And the industry and the analysts are sitting here, and I can come up with 1,000 reasons with data why it won't work or why it doesn't make sense. But none of those arguments deal with the air issue. So I feel like to a degree, we're making an argument against something that they're not arguing. They're saying, yeah, but clean air. And I'm saying you're not going to get there. You're going to lose jobs. The consumer loses choice. Macroeconomically, you're hurting the state, and they're going, but clean air.
Right, but clean air.
And so
yeah.
I feel like we have to kind of address that. And I don't know how to do it, because if you think about voters and, the politicians in the midterms are going to be saying like, well, my opponent wants you to breathe dirty air.
Yeah.
And it's like, I don't know that I have, as a competitor, I don't know that I have the attention span of the voter long enough to explain why that's ridiculous. Right. So, it's an interesting dilemma, because we're sort of proving things 100 different ways, but not the actual thing, which is ridiculous, right?
Yeah.
Because really all we're doing is moving the air to somewhere else.
Right.
Whether, because we're not talking about shovel in the ground to disposal of those batteries and the entire value chain through it. You don't have time in a 15-second political ad to say
right.
that's ridiculous. You show a smokestack on the
exactly.
air and you go,
and people go, oh my God, we don't want that. Right.
Right.
Yeah.
Look what my competitor wants you to breathe.
Exactly.
So
exactly.
It's a very interesting thing, but in terms of doing the numbers and looking at it, it's every state is so far away from the 43% goal. And then, Jim, throw in the fact that federal subsidies are going away for these things.
Yeah.
So New Jersey, for example, is a CARB state, and we're 8 to 10% in battery electric penetration with the support of the
that
state
goes away.
and federal government.
For sure.
Yeah.
So what does that look like?
I don't know. Yeah, I don't know how it gets there. And and the other interesting thing, you hear language out of California or out of the California Air Resources Board that says, oh, we're going to work with the manufacturers to make sure that they're not penalized. And it's like, well, then why are we doing this in the first place? Like, why let the market be organic?
Yeah.
There is a federal standard. Let everybody follow the same thing, because on the other side of this, what you have, Jim, is manufacturers who essentially have to have two allocation strategies.
Yeah, of course.
One for the CARB states and one for the non-CARB states.
That's
and it's
right.
very difficult to do business that way. So like I call it a very unnatural, a very unnatural market. It doesn't make a lot of sense in a lot of different ways, but I think we have to address the concerns or get people to pay attention long enough to understand that this is not good for a lot of different constituents and in different ways to talk about forcing this 100% zero emission vehicle by 2035. It's not possible.
Hey, in our final minutes together here, given your research background and what data trends are you watching closely right now in the industry? I know that you've got your hand on a number of them, but what do you think the dealers should focus on?
Well, I think the thing is, like I mentioned, scarcity, right? The value of scarcity. And I honestly believe when you go all the way back to the factory, right, and the capacity or under capacity utilization issue, coming forward all the way through to the retailer and out to the consumer, I feel like this has to be a smaller market.
Yeah.
I feel like this 15.5, 16 million unit at the end of the day is way healthier for the manufacturers and the retailers. I don't know if the manufacturers realize that. It seems like they're starting to. So what I would tell retailers, and what I have been telling retailers, is expect that, right? Don't think about this 17.8 and 17.3 as the way forward. I think that's very unlikely. I think what you're going to get, if this industry is going to be healthier going forward, it has to be less is more.
Right.
Less capacity, less supply, but stronger pricing, right? More transparent pricing, better margins, and fewer units. But the revenue and the profit pool is actually growing, because it's not this throw money at demand kind of problem.
Yeah.
So that's what I've been telling dealers. Now, along with that is, so that's just one part of their business. The full line franchise dealer base is new vehicles is one part of it. Expect that to be a little bit smaller. If it's a 15.5, you know how to make money doing that much business.
That's right.
But then it's about used vehicles, which, is a tough market still, but it's fixed operations, it's parts, it's service.
Right.
So there's that revenue diversity. And what I'm saying to the franchise dealer base is expect that for new vehicle to be a little bit small, but be ready to pivot because there's going to be opportunities in some of your other business units. And it's time to use new technology or new processes to maximize in some of those other areas. I think it's time to do that. When you think about supply demand balance and the most profitable period being 2022, it was easy, right? New vehicles came in the morning, they were gone in the afternoon. So that was where all the focus was.
Yeah.
And I think it's time to pivot away from that mindset and say that part of my business is going to be a little bit slower in terms of volume, but I have all this other opportunity.
Right. Kevin Tynan, Director of Research for the Presidio Group. Thank you so much for stopping by CBT News. I know that our viewers get a lot out of your visit with us, so thanks so much. And until next time, stay well. And I know you got a lot of travel, so safe travels ahead. Appreciate it.
Thank you, Jim.
Thanks.
Thanks for watching Inside Automotive with Jim Fitzpatrick.